What's up, guys? Andrew Briscoe here with Keller Williams Elite. And this week, we're going to be continuing talking about the 2021 housing market and what exactly is going on with it. If it's going to crash, if it's going to stay like this for a while. Now, last week we talked about lumber prices, why they're so high, and how that's affecting the housing market. This week, we're going to be talking about interest rates. I'm going to tell you guys a little bit more in detail about why the interest rates are so low right now, how the interest rate is even determined, and then also how that's affecting the housing market and how it's going to over the next few years. So one of the most common questions I've been asked recently is, why are interest rates so low? And typically the Federal Reserve will lower interest rates when we're in a weak or less stable economy. Now, what this allows people to do is make more big purchases like homes, cars, or other home goods because they can borrow more money for a lesser payment with lower interest rates. Now, this also helps banks because they can lend more money to more people. And of course, it helps homeowners or home buyers because they can purchase more house for the same or less payment than they would if interest rates were higher. Now, most of the time when you ask the question, why are interest rates so low? People are just going to leave it at that. The feds have lowered interest rates to stimulate growth in the economy, and once things stabilize, they'll start to raise them. And this is just the normal ups and downs of the market. But I want to go a little bit deeper into this for you guys and explain something called the real interest rate. And this actually affects the market and interest rates more so than what the Federal Reserve sets them at. To understand this better, there's something called the equilibrium real interest rate. Yes, I'll say it again, the equilibrium real interest rate. Now, it's hard to determine exactly what this number is, but it's basically just a more accurate representation of what the interest rates are rather than what the Fed set. Although it's hard to determine this number, the equilibrium real rate is determined by employment of labor and capital resources with some time for adjustment. Now, the equilibrium rate is typically lower in a slower, less stable economy because capital investments are limited and there's less room for profit. So if the feds want to see full use of capital and labor resources, they want to try to keep the interest rates as close to the equilibrium rate as possible. If the Fed set interest rates too high, this could slow the economy and cause a recession because capital investments would not be profitable enough. On the other hand, if they set interest rates too low, this could cause overinflation, which is also not ideal. So as of now, the feds have pledged to keep interest rates low until about 2023, although we may see a slight rise in the interest rates at the end of 2021. So how does this affect you as a homeowner or home buyer? Now, a lot of people are asking, should I wait to buy a house because this crazy hot market, houses are going over asking prices and the prices are just being driven crazy high? And I want to break this down for you and show you how you actually are better off taking advantage of lower interest rates rather than waiting for the prices to go down. If you were to purchase a $200,000 home right now with a 5% down conventional loan and the average interest rate of 3%, your monthly payment would be $1,354, and that includes your taxes, insurance, and private mortgage insurance on the loan. Now, what would happen if you waited to buy that exact same house when the market turned, and let's say it's worth $180,000 now? Well, you actually might be paying more. Let's say you wait 3 to 5 years for interest rates to start to rise and home prices go down a little, and that same house is worth $180,000 now. So if you were to use a 5% down conventional loan for a $180,000 home at now a 5% interest rate, your monthly payment would actually be $1,404 a month compared to $1,354. So you would actually be paying more in interest for $20,000 less of a purchase price on the same home. It's really not worth it to wait in this market. The interest rates are so low that it actually makes more sense to buy a home now rather than waiting for interest rates to possibly go up and home prices to go down. So anyway, guys, I hope that cleared up any questions you have about the current interest rates and how it's affecting the market and how it affects you as a home buyer. Now, if you have any other questions about buying a home, selling a home, or investing in real estate, I would love to help you. Reach out, send me a DM, and I'll answer any questions you have.